The next topic I'm going to talk about are LBOs, which is short for leveraged buyouts. Leveraged buyouts are essentially when a private equity firm buys a company but does it mostly debt, kind of like, it's not quite a mortgage because it doesn't have the payment structure, but it's kind of the same idea of buying a house with a mortgage versus cash. Your cash on cash return is higher because you don't have to put as much money down. And it's the same effect with LBOs, except unlike a house where the mortgage payment is fairly fixed, you can cut your costs of the business operations. If you think the business is poorly run or the management is overpaid or inefficient or whatever the reason, if there's an opportunity for cost cutting, you can cost cut and lower that cost and then use that extra cash flow to pay down the debt faster. And so you don't only accrete wealth from paying down the debt, but you also do it from a higher valuation when you sell it to either another LBO firm, or you take it public through the initial public offering, or sell it to a strategic buyer. And this has been a virtuous cycle for the last 4 decades because the LBO strategy really got started in the early 80s when interest rates were at their peak. And when interest rates fall, the interest expense is lower, and therefore it makes deals at higher valuations make sense. So the LBO multiples have consistently trended higher since the 80s. And so it's just this chain that just these private equity firms sell to each other at higher prices. It also helps that post '08 private equity got disproportionate inflows due to the fact that it didn't have as bad mark-to-market volatility in the financial crisis because the nature of private investments are less liquid. So that's a whole nother topic which I may have to save for another iceberg. But the question now really with LBOs is, when interest rates start to trend up for a multi-year period, how does that affect the viability of this strategy? It's worked great on the way down. I'm not so sure on the way up. The other notable thing about LBOs is it's how 2012 Republican presidential candidate Mitt Romney made his money with Bain Capital, was heavily involved in these type of deals, and it was controversial to the practices that they used to cut costs. The next topic we're going to talk about are zombie companies. So what are zombie companies? A zombie company essentially, and I did a video on this too, so I'm not going to go too deep into it. It's a 12-minute long video. I commented on it, but that a zombie company is a company where essentially you have to borrow to pay back interest payments. There's kind of like this downward spiral that they can pay back the interest, but they can't pay back the principals. And a lot of companies got into the zombie condition by doing share buybacks when they didn't have organic growth, or to cover like a financial crisis or accepting bailout money. Banks are the most common assets to have be zombie status, especially in Europe and Japan. And the problem is that these things choke economic growth because they employ people in firms that are not financially viable in a free market. They prevent competition who is healthier from coming in and taking their place. And it just makes things a lot. And the heavy indebtedness also just prevents longer term strategic actions. And just look up whether it's the states bailing them out or it's companies getting really generous financing at low interest rate environment. It's one of the causes why we've had what people think as a more structural stagnation in many aspects of the economy. The pandemic made this worse, where pre-COVID, like less than 10% of companies in America were zombies. Now it's most likely over 20%, at least the last statistics I've seen. Europe, it's over 25, and Japan, it's even higher. The zombies are not good in horror movies, and they're not good in the business world either. Again, watch my video for more on zombie companies. The next thing I'm going to talk about, though, is the Plunge Protection Team, which is kind of more of a nickname for a Washington organization called the President's Working Group on Financial Markets. It was started in 1988 by President Ronald Reagan. The plunge, whenever the market goes down, there's volatility, but you get a bid unexplicably. The plunge protection team is often credited for that. It was created in response to the 1987 crash, where the market crashed 25% in a day, which I think is still the biggest percentage crash in a single day. It's basically, the working group consists of the Secretary of the Treasury or their designee, the chair of the Board of Governors of the Fed, the chair of the SEC, and the chair of the CFTC, or their designated appointees. And what their role apparently is to stabilize markets, and to there's a lot of conspiracies that they work beyond their legal mandate, and they're buying things such as futures or ETFs or stocks to support the market or bonds, when that's not really in their mandate. The evidence on it is mixed, but it's a common conspiracy theory in finance that whenever things get a little shaky, the plunge protection team is going to come and save you. It's also explained kind of the evident bullishness right now in the market, because people think whether it's the Fed or like as I said, the Don't Fight the Fed in the last video, or the plunge protection team, the government has your back. Maybe they do, but that's kind of my thoughts on the plunge protection team. Next, we're going to talk about venture capital herding. Well, venture capital, surprisingly, I'm like 1990 to 2020, and worse, from 2000 to 2020, has actually, on a risk-adjusted basis, not been one of the weaker performing assets. You would have been better off just buying a levered Russell 2000 ETF, which is small cap equities in the U.S., than you would with venture capital. Whereas venture capital, a lot of people now do invest in it, particularly because it's a way to make an idle rich person look like they're doing something. And again, there's a lot of great venture capital funds out there. In fact, all the best deal flow tends to go to the top 8 venture capital funds. So if you look at the skews of the returns on on VC and a skew of alpha, it's heavily concentrated in those ones that get the access to deal flow. And there's a lot of smaller ones that are run by ex-entrepreneurs who actually kind of know how to see talent because they did it before. But there's also a lot of people who are becoming VCs just because it's a trendy thing. And there's this whole infrastructure. This guy, Jake Tran on YouTube, did a great video on it, where you basically have a company, you buy it at a seed or Series A, you tell your friends how cool it is, and they will bid it up at a higher valuation on Series B, and some other VC will bid it higher on Series C. And these valuations really don't mean anything other than on paper to increase the wealth of the founders and the venture capital funds. But this herding to these few concentrated unicorns has created extremely bloated valuations in the technology sector, or companies that are very popular among the VC crowd. And I thought they would have a problem when it came time to exit, or they would have to eventually show a profit. But since real rates keep falling, the timeline to having to show a profit keeps going away. And then the public market, either through traditional IPOs or SPACs, has been a very friendly place for a lot of these overvalued companies to get sustainable bids, because now the public markets and particularly retail traders have now a more venture capital mindset and are willing to eschew traditional valuation and profitability metrics in favor of potential. So when it was really started as a problem in the San Francisco VC community in the early 2010s, that I thought would eventually result in there was a minor correction in the unicorns in 2018, like WeWork, for example. But it evolved really to that the public market became the new higher bidder and kept the train going a lot longer than I thought it would last. We'll see how this ends. Next is TSLAQ. TSLAQ is a community on the internet, particularly Twitter, it's Seeking Alpha, that thinks that Tesla is going to go to zero and Elon Musk is fraudulent as a CEO, and that the company has never really been able to make money, and it's not as successful. Like, it's amazing. It's only really gone as far as it is because of their loyal fan base and the meme nature of the modern economy. TSLAQ is an abbreviation. They add a Q to the stock typo of Tesla because when a company goes bankruptcy, their stock has a Q added to their ticker. That's where that comes from. These people have put way too much brain power in a stock trade that has not worked. I know I had short positions in Tesla years ago. Thank God I managed my risk. I didn't really lose any money on them. But if you did, after that big earnings report in Q3 or 19, when they actually did get the fourth, when they started to show like GAAP profit, and then they got the 4 quarters in a row for S&P inclusion, shorts got railroaded because there were so many people, from smaller sophisticated investors all the way up to big hedge funds who had heavy short positions, and they got squeezed pretty bad. It was GameStop before it was GameStop. Yeah, what do I feel about the fundamentals of Tesla? They are questionable, but we live in a market right now where, and I did talk about how this in a video, how high Tesla can go, that has diverged from that from a while ago. I never thought Tesla was going to say go to zero. I thought it had a much lower valuation than when it was trading. I still think it is a severely overvalued company. But I feel a lot of sympathy with TSLAQ people because they had a lot of facts on their side. It's just that the nature of markets changed and the type of people investing changed, and the preference for growth over value, and Tesla was the ultimate growth potential stock and the ultimate meme stock, overwhelmed the fundamental investors who've continued to shrink as a percentage of total traders out there. So yeah, TSLAQ is the story of defying gravity that keeps going. I don't know how many TSLAQs there actually are left because I stopped kind of following TSLAQ in like 2018, but it was a fun little phenomenon. And yeah, next we're going to talk about is Jekyll Island. Jekyll Island is the island off the coast of Georgia where senators and bank leaders met to draft the Federal Reserve Act, and they did it in complete secrecy because the general American public did not like the idea of a central bank. Andrew Jackson got rid of the Bank of the United States in 1832 and paid off the national debt, and his populist belief was kind of more in line with the general public even 80 years later. But after the panic of 1907, the banking interests wanted to do something that wanted to arrest market and economic volatility, because the main consequence, as I mentioned, of the gold standard and a super hard currency is economic volatility. And the Fed, creating the Fed would do that, and lowering volatility benefited the bankers greatly. And they created the Fed as a private organization that has private shareholders but works in the interest of the government. And a lot of these private shareholders happen to be banks from that era. The fact that they did this in secrecy and they had another shenanigans around it has made people question the Fed. There's a lot of anti-Fed conspiracies. There are legitimate criticisms of the Federal Reserve. I'm not a particular fan of financial repression or keeping interest rates artificially low for extended periods of time. And I can understand why they do that, because there are vested interests who benefit from such thing. But not all the most wild conspiracy theories on the Fed are true either. And that's why Don't Fight the Fed is such a real thing, because Don't Fight the Fed is a derivation of a lot of the the Fed, the cynicism towards the Fed through the Jekyll Island and all the conspiracy theories around it. If you want to learn more about this, read the book The Creature from Jekyll Island. Next is the Petrodollar. The petrodollar is the idea that a lot of the Middle Eastern oil countries peg their currency to the US dollar and price the sale of oil in dollars, and therefore effectively the crude oil market and the trade of the crude oil market provides its support and demand internationally for US dollars and a reason to hold US dollars in reserve. And why do these countries are willing only to sell in US dollars is because they do that in exchange for military protection from the United States. Saudi Arabia and the Gulf states have major geopolitical tensions with neighbors such as Iran, and having the protection of the United States helps, because these countries are ruled by absolute monarchs who use most of their funding on social spending to improve their country's people's living standards, so that people don't question the fact that they don't really have much political power. And they do spend quite a bit on military too, but I've had enough of critiques of Saudi Arabia on YouTube, so I'm not going to really dive any more into that. Find my other comments on that. But the general idea is that so the dollar is priced in oil, and if countries decide to switch selling oil into other currencies, that it would cause the US dollar to collapse. There are conspiracy theories that Iraq was invaded by George Bush because they wanted to sell oil in euros instead of dollars, and the US was not going to put up with that. Same reason why Gaddafi got taken out, because he wanted to sell oil in euros or in gold or some non-dollar asset, and Libya is a big oil exporter. China has recently released a futures contract that allows you to buy oil priced in yuan. Actually, they are the biggest net importer of oil now in the world, and so far it really hasn't done much to undermine the dollar. The RMB has strengthened quite a bit, but I think that's more for other reasons that really are not relevant to the whole petrodollar story. So yeah, I think oil being priced in dollars does help, but I think that currency flows are driven by a lot more powerful variables, and the import-export balance of the U.S. is not entirely dependent on oil anymore, especially now that the U.S. is one of the biggest producers of oil in the world. The petrodollar may have been more important from 03 to 07 when you had the combination of high oil prices and large net importing of energy from the United States. But as fracking technology and new discoveries and more energy efficiency in the economy has kind of devalued the petrodollar. Next is John Law. John Law is famous for the South Sea bubble. Some would argue he's the Elon Musk of the 1700s, of that era, because he sold this imagination of the potential of the new frontier in America, when it's really just the territory he was doing is a bunch of swampland. And he gained so much power and influence that he was helping craft up fiscal and monetary policy for the French king, and it became one of the, prior to Bitcoin, the biggest percentage rally like in a single asset, and in terms of scale, and it caught the imagination. Like, you had a speculative mania, kind of like tulip mania, except the South Sea bubble at least wasn't. The South Sea company was actually a real company, and at least had a promise of doing something, which is settling the New World and extracting the resource from the New World. There's a similar company that came in this era as well, the Louisiana Company. And when basically when the results couldn't live up to the hype, it collapsed as quickly as it rose, and John Law suffered the consequences in terms of his reputation and the law. And again, it's another example of a famous bubble in the economy. Next, we're going to talk about Taleb's Turkey. What is Taleb's Turkey? Well, this concept comes from Nicholas Nassim Taleb, and I have the chart posted as I'm talking about this. It's the idea when you sell volatility, which is basically betting on things just kind of staying the same, or that things that you're not factoring in risk as much as you should, like selling options. It's an example of a strategy that fits Taleb's Turkey. Your returns are very steady on the way up, and then one day it just crashed, and it's like the "and it's gone" scene in that South Park of the financial crisis. It's like the turkey. The turkey's life progressively gets better the first, say, 200 days of its life, and then November, shortly before Thanksgiving, its head's cut off and it's dead and its life's gone, like that. And that's why it's called Taleb's Turkey, because he uses the analogy of the Thanksgiving turkey. We saw this with the XIV and the short VIX ETFs in 2018, where they steadily rallied for years, and then one day when the VIX doubled, which was Volmageddon, they went from $100+ a share to zero, like less than 10 in one day. The next thing just completely got destroyed. And generally, any sort of vol sale strategy, that's what eventually happens. The thing is that there's always an excuse on why this time is different, so people keep doing it. And it's also the path dependence of investors' preferences, and also the Sharpe ratios, which heavily reward low volatility and consistent returns over volatile returns, even if the volatile returns perform better on an absolute basis, make this type of pursuing a strategy that's a Taleb turkey trap to be financially appealing. So that's the story of Taleb's Turkey. You got to watch for the risks of that happening to you. And then the last one I'm going to talk about is the Chapwood Index. The Chapwood Index is just one of many examples of this, but it's all part of the common theme that people do not believe the actual inflation numbers that the government produces. As part of my research service at my firm, I create alternative research data, alternative inflation data, to try to use more private sector analysis components to the CPI and see what I get in terms of an inflation print. It's generally higher than the government consensus. Not always, but the thing though is that a lot of people think that, but I don't think it's that much higher that it's severe to the point that people are becoming poor and impoverished nations in a decade. You've got things like the Chapwood Index, for example, or John Williams Shadow Stats, which basically have argued that the U.S. changed the way it calculated inflation in the 90s, which is true. And because of that, inflation is way higher than expected. I think they are discounting some of the deflationary impacts of technology. But the thing is, and that has lowered the cost or eliminated the cost of certain things. Like, say with an iPhone, I don't need to buy a camera anymore. I don't need to buy a Thomas Brothers book anymore. But yeah, I mean, like the Chapwood Index, for example, thinks that inflation is averaged in New York and Los Angeles 11.5% over the past 5 years, which I just don't find that to be credible. That means your living standards have gone down 50% unless if your wages have gone up to match that over the last 5 years, which is just not true. I think in some aspects of the economy you see Chapwood-like levels of inflation, such as real estate and healthcare. Those are due to more structural reasons and are more Fed sensitive. Other assets, such as manufactured goods, commodities, until very recently at least, and services where there are lower barriers to entry, the increased monetary easing is not just demand booster, but it's also supply booster. Like the shale crisis was often blamed on QE because they got a bunch of cheap capital to produce more cheap oil. So You can't really have it both ways with some of this stuff. I generally think, though, inflation is higher than what the markets expect it to be in terms through the break-evens and the tips bonds contracts. And I think the government numbers are a little bit understated, and there are valid reasons for them to do that, which, not to get too conspiratorial, but social security payments and income tax brackets are based off the CPI and are indexed to it, so they rise proportionately. So if you're a government and you want to raise taxes or cut spending without doing it directly, fiddling around with the inflation number is the best way to do that without people noticing it outside of economists in investment circles. Try explain the concept of the Chapwood Index to your layman who doesn't follow finance, and it might be a little bit over their head. So yeah, I mean, I think these things serve a role to you gotta question the narrative of a lot of economic statistics, not just inflation. Other ones might not be as accurate as per se. Like in some countries like China, like even the consensus believes that they're not real. But even in countries like America or Europe, you have to look at incentives, and you have to see the real world around you and see if it matches what you're seeing in terms of inflation and unemployment and other economic variables, and make personal and financial decisions accordingly. Thank you for watching. Feel free to keep joining us for these. And again, nothing on this Iceberg series is investment advice. Please do your own research and due diligence before making any trades. I didn't really talk about any trades. I don't have any positions on right now. So that's all really for my disclaimers. And thank you for watching, and enjoy your summer.